Hey, good morning, everybody, and welcome to this Thursday, March 7th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another market open and another market trading day. Right now, let's see, we got futures up almost 0.5% on the S&P 500, Nasdaq up almost 2/3%. And we've got the small caps up about 0.5%. So pretty good, potentially pretty good start to the day. Market hasn't really wanted to give up much in terms of the gains that we've seen since the beginning of the year. It's been like pulling teeth to the downside, trying to get prices to come down. And as a result, we just kind of keep hovering in kind of range bound, although mid caps continue to do pretty well. And small caps looking good. Banks really starting to heat up again. I was looking at the chart earlier today, and we'll take a look at it later in the show. But the bank index, the AD line, has been absolutely soaring. So in addition to just my overall feelings that banks are going to do well, it does appear as though we're getting a lot of confirmation in that area of the market. 10-year Treasury yield moving back down again. We're going to take a look at that in just a minute as well. But first, let's go ahead and take a look at the recap of the action from Wednesday. Dow Jones Industrial Average was up about 0.2%. S&P 500 up 0.5%, or roughly 0.5%. Nasdaq up 0.2%. Mid caps are about the same. Small caps up 0.75%. And transports gained a little bit of ground yesterday, up 0.3%. So across the board, we did see a move back to the upside. It was somewhat tainted in what led the market to the upside. We saw utilities moving on to the sectors down here. You can see utilities jumped about 1 full percentage point. The staples up more than 0.8%. Those were your two leaders, and those are about as defensive as you get. But technology, which started the day not very strong, rallied and finished up about 0.8%. And you can see under the industry groups, the semiconductors leading once again. I mean, you would think at some point the semiconductors have to kind of take a break. But when you're talking about lower rates ahead and you're talking about profits accelerating the way they have accelerated in many stocks within that group, this is kind of what you get. You get a melt up. And we're not really seeing a whole lot of difference. Any kind of reports or anything out there that's telling us that we need to be overly careful. Consumer stocks in total, I think, are still struggling a little bit, but the relationship between the two has actually been pretty good throughout the uptrend off of the October 2023 low. So we've been seeing some pretty good action in terms of discretionary versus staples. But overall, if you look at the XLY, which tracks the consumer discretionary sector, it's struggled. And I can give you one primary reason why. Tesla is close to, I don't know, it's probably about 1/5 of the entire XLY, and Tesla just keeps going down despite the overall movement in the market to the upside. Amazon, which had been performing pretty well, but it's pulled back in recent sessions, and it too is a big part of that XLY. So we're not really seeing the strength that we need to see in that area. I'd like to see more strength in consumer discretionary, but in order to get it in the XLY, we're going to need to see a continuing rally in Amazon. We're going to have to see a turnaround in Tesla. Until that happens, we're probably going to continue to see the XLY move a little bit, on a relative basis anyway, down versus the S&P 500, and that's what we've been seeing. Two financial groups, though, included here. We've got the casualty and property, casualty and property insurance index, which has been rising, breaking out yesterday. And look at this AD line down here on the bottom, continuing to move up with the action in the DJUSBK. That's really good. And then you look at the underwriters, and it's reinsurance. And when you look at the reinsurance group, there's a pretty big, significant area of resistance at about 510 or just above. And we finished at 509 yesterday. So this is another group that's on the verge of breaking to the upside. And these are areas in the financials that are not banks. Again, I'm going to talk about the banks a little bit later. Banks did go up yesterday, still seeing more support for the larger banks than for the smaller banks, but the smaller banks have certainly improved, and their AD lines have been improving as well. So I think the foundation is being laid for what we're likely to see later in 2024, which I believe is still going to be a really strong banking group as the rates continue to come down, or as they start to come down. I mean, the short-term rates haven't budged yet because the Fed hasn't cut. The last thing they did was hike, at least directionally. Last couple meetings haven't done anything. But then on the long term, we've seen the 10-year Treasury yield moving back down as inflation fears have subsided. So if you've got moderate growth with very little inflation, or at least falling inflation, that's a recipe for the Fed to cut, and for valuations, for the most part, to continue moving higher in stocks. At least that's the way I see it. Moving on to the 10-year Treasury yield. Let's get the latest here. Down another 3 basis points today. Now we're below the 50-day moving average. So we have now gone down. Let me see. 1, 2, 3, 4, 5. This is the 6th day out of the last 7 where we have seen the yield down. If it holds, if today's move to the downside holds. We lost the 420 area of support, 4.20%. That was the yield support. And that came from that reaction high right there at 420. So we had a big drop starting at 420, came back up, tested that area, rolled over, and then went through 420 the day that the January CPI came out. That move to the upside left yield support at 420, which we took out along with the 20-day moving average back at the beginning of the month. So, and it's been a consistent move lower since then. So as yields continue to come down, all that's doing is making future earnings more and more valuable. So if we continue to have a resilient and I wouldn't say super strong economy, but strong enough, certainly, that combination is likely to take prices higher. And if the economy were to strengthen even just a little bit to go along with those rate cuts down the road, that combination, I know everybody's looking at the market thinking, well, it's overbought, can't go higher. I can tell you, it can go a lot higher. It can absolutely go a lot higher. I had a pretty modest forecast. I don't think we're far enough into the year. I'm not going to share it, but I had a pretty modest forecast back at Market Vision 2024, thinking that we were going higher this year. But I think we could eclipse it. I mean, if we don't get the pullback I expect here, I would still be looking for a summertime pullback as the presidential race heats up. I mean, that's just historically what we tend to see weakness over the summer months and into early fall. And then just before the election, we tend to pick back up again. And then once we get through the election, no matter who gets elected, it's the uncertainty is done. There's no uncertainty at this point, or at that point. So usually the market rallies pretty strongly in the year end. So March is one of these periods when the market tends to pull back. We're just not seeing much in the overall indices, which I'll show you again in just a second. And that makes me think maybe the target at the end of the year needs to be a little bit higher than what I talked about back in early January. Anyway, S&P 500. Looking here, you can see the S&P has been in this constant trend to the upside. The rising 20-day moving average has continued to hold very, very well on any pullbacks. Just to give you an indication of where the all-time closing high or candle body high is, our all-time closing high is at 51.3708. We did get up to 51.4967, so let's call it 51.50. And if we see 51.50 print on the S&P 500, it's another all-time high. And we closed yesterday at 51.05. And right now we got futures. Well, the spider is trading at 512.23, which is up about 0.5%. So that would translate into roughly about 25 points on the S&P 500, which would take us up to about 51.30, which is getting close to the all-time high close, 51.37. And that all-time intraday high, which we saw back on March the 4th. That was Monday of this week when we hit 51.4967, just below 51.50. So S&P continues. I mean, this bull market remains extremely resilient. There are a couple little short-term things that we need to be cautious, need to continue to watch, something like the 5-day moving average of the put-call ratio, which right now is neutral. I didn't update it for yesterday, but prior it was still neutral. If we get to the point where that marks an extreme complacency level, then that's normally where we see somewhat of a pullback. But again, the market just doesn't feel like there's going to be a deep sell-off, even when there's an opportunity, when things get a little bit rough. I mean, let's go on to the Nasdaq 100 chart. I mean, on Tuesday, we had an intraday move that was below the 20-day moving average, which we haven't seen, but maybe about 5 or 6 times the entire year so far. Didn't seem to hurt the bulls at all. We just had a nice little rally into the close, got back up above the 20. Then yesterday we gapped higher, pulled back, looked like we were going to give away those gains, and rallied again toward the close. It's just been that kind of a market. And as I've said many, many times before, shorting secular bull market advance is like financial suicide. It's really hard to, I mean, we can look at different signals that say, hey, the risks are a little bit greater in the near term, and maybe we get a little bit of a pullback, which, by the way, I think would be really healthy for the market. I'd like to see a little bit more of a pullback, but it hasn't been in the cards. But trying to bet against it, putting your money against a bull market is different than maybe just being a little bit cautious, being cautiously bullish. And so that anytime I talk about, market maybe pulling back a little bit, I'm not bearish. I am not bearish at all. I recognize how markets work, and you do have pullbacks from time to time, even in a secular bull market like we've been in since 2013. We had a cyclical bear market in 2018, the trade war, fourth quarter of 2018. We had a cyclical bear market with the pandemic. That only lasted about 4 weeks, but we took a big hit from February to, I think it was March 23rd of 2020. Then we had the 2022 cyclical bear market that lasted 9 months, or even into a 10th month. That was all part of a secular bull market. We had the correction from July to October of 2023, where we had like almost an ABC, or maybe even a 1, 2, 3, 4, 5, whatever you want to call it, pattern to the downside. But then as soon as the historical bullishness kicked in at the end of October, prices just miraculously started going back up again. So it's hard to bet against a secular bull market. You're going to be right more often than wrong by remaining on the long side. I mean, if you can get out, if you can see enough warning signs to get you out, or at least maybe to hedge a little bit, or maybe move some positions into cash, for a correction like we saw last summer, or for a cyclical bear market like we had in 2022, that's awesome. That'll do wonders for your long-term financial security. They're not always easy to spot, but sometimes we can kind of see them, or certainly we can see them while they're evolving, but sometimes we can see some signals before that. Not really seeing anything like that would suggest to me that we're going to see a big sell-off. So again, I just maintain my bullish stance. I mean, if you're asking me, Tom, are you bullish or are you bearish? I am bullish. 100% bullish. I think market goes higher. Does it have pullbacks from time to time? Yes. We'll try to figure out when those are, or when the risks are elevated to have those. But I do not believe we have any kind of a cyclical or secular bear market on the horizon. Stock prices, in my opinion, will be higher at the end of the year than they are right now. They're going to be higher in 2025 than they are right now. I don't see a let up in the bull market. So I just want to be clear about that. Moving on to the IWM, you can see the cup, the handle, the breakout. Lately, we've been seeing a little bit more of filled candles, just meaning we've been closing below the opens. So that's maybe a little character change that we've seen over the last week that really we hadn't seen much of in February. It was mostly just movement to the upside from the opening bell. And if we did see any kind of morning weakness, it quickly evaporated and we went back to highs later in the day. It's been a little different the last 5 days. I mean, we're just kind of consolidating here, but we're doing this above the rising 20-day moving average, which is above the 50-day. We've got the PPO still rising, coming off of the center line. There's really nothing here that looks bad. In fact, I really like the small caps to go higher. I think we're breaking out. This cup would measure from the top of the cup to the bottom of the cup is almost $20. So when you break out from the 205 level, we should be looking at roughly 225 on the IWM. We're at 205 right now. So we still got 10% upside just for this initial measurement. Now, these don't just measure, the highs that we're going to see for the next 5 years. This is just an initial measurement. That's the beauty of patterns. They give us a target. They give us an initial measurement that we should be expecting. So short term, yeah, we could hit a 20-day test along the way. Could be today, could be tomorrow, could be next week. I don't know. But I believe looking further out, there's a much better chance we're going to see 225, in my opinion, than a total breakdown in this index. What, odds, I don't know what odds I'd put on them, maybe 75, 80%. I feel pretty strongly that we're going to have a move to 225 on the IWM. And I think all the major indices go up. At this point, I'm just wondering, and I'm going to be watching to see whether or not the IWM leads. Because if it starts to lead and we start getting money rotating into the group, it could be a long-term leadership role of small caps. I know you've been, looking the last 2-3 years, you're like, no way. Small caps been horrible, blah, blah, blah. Well, the economy cycle, everything cycles in the stock market. And the way you make money is recognizing a new cycle early on. That's the best way. If market's going down and you're starting to see signs of it improvement, getting long at that point is a whole lot better than waiting for 1,000 points to get long. So that's why we do all of the analysis that we do, is to try to figure out where the market's going before it actually goes there. So you can prepare yourself, or at least begin to start preparing yourself for it, just based on the risks. And a lot of times it's not the risks of things going lower. Sometimes it's the risk of things going higher and you not being in. That's a real risk. That's the risk that most people have the most problem with, because they always want to shoot down a bull market. First of all, when the market goes down, they think it's just going to keep going down. And when it starts to go up, it's like, oh, I missed some rally. I'm going to wait for it to come back down. And then it goes up further. And then it's all of a sudden people start talking about a bubble. Anyway, I go off on a tangent. I don't see any characteristics of a bubble. If there was anything that just looks way stretched to me, it's the semiconductor group. But again, if you got an economy that's strengthening and rates coming down and earnings in those stocks going up rapidly, I don't know where to pinpoint a top. It could be another 50% or 100% higher before, with pullbacks along the way. I'm not saying it's going to go straight up, although it's trying. But yeah, it's just hard to bet against a secular bull, secular bull market. And that's what I think most investors are facing right now, trying to figure out where to get in and not being comfortable getting in because we've gone up. Well, if I told you we're going to be at 6,000 sometime next year, or in the 6,000s, would you want to be in at 5,100? Because I think there's a pretty good chance that we hit 6,000 next year. Anyway, chart of the day. So again, you want to check us out at Earnings Beats. Find out why we've had a growing membership for many, many years. Start your no-cost trial, 30-day free trial. You do have to provide a credit card, but you'll certainly see a lot over the next 30 days, things that what we do. Of course, that'll take you right up into the start of earnings season again, into early April, when I think we're going to be running again to the upside. But check us out and start that 30-day trial. If you scroll down further, you'll see our Earnings Beats Digest newsletter. Name and email address, no credit card, completely free. This is where we just simply give back to the community, folks that follow us, whether you're following us, from over at Stockcharts or YouTube or both or whatever. I know we've had a lot of folks that have been following us for a long time. make sure you at least become a subscriber there. We do free events from time to time, and we always reach out to our Earnings Beats Digest community when we do these free events. So it's not just about charts 3 times a week. It's about learning more and more about the stock market and being able to attend, to be invited to those free events. So make sure you sign up today. All right. Let me move on and show you the chart of the day. So I talked about banks earlier. And so I wanted to show you, I talked about how strong the AD line is. First of all, you can kind of see the move here. We got a little bit of moving up in the AD line. We got a move here. Again, a little bit of a rally. A move here, a slight rally. And then we went down. AD line's going down with it. Then we're moving up. And since that October low, I mean, if you look at this AD line, I mean, it is just consistent. Even when we've had pullbacks, it's like, I mean, look at these candles. I mean, I know on the chart, might be a little small, but on your own screen, just pull up a chart of the DJUSBK daily chart for a year, candlesticks, and then have the AD line down below and just take a look. I mean, let me see if I can shorten this. I'll make it even easier to see. Let's go 6 months. But what I'm trying to look at, maybe, don't need that, but let's go 3 months or 4 months. Now, what I'm looking at is on these pullbacks, do you see almost a lot of these candles with the long tails to the downside? That means earlier in the day, this was intraday lows. But when you come back up, you're finishing with these long tails to the downside, meaning that you're actually rallying late in the day, most of these days. And when you do that, even though you went down on many of these days, because you're finishing in the upper half of the candle body, the AD line continues to go up. So a day like, I don't know, what is this, January the 10th, right here? We have that hollow candle, kind of looks like a hammer there. That day, we finished almost squarely on the high. And so what you do on those kinds of days is you take the volume, essentially, and just add the entire volume to the AD line. If you finish in the middle, like here's a day, it looks like maybe January 17th, where you just kind of finish right in the middle, the AD line just goes flat that day. If you finish toward the bottom, it's going to come down with the volume as the multiplier. And when it finishes up at the end of the day, then your AD line is going to go up. So even though prices were going down here, AD line was rising. Even though prices were going down here, now we started off these 2 days, we had a little bit of a hit because look at this day, we had big volume and we finished on the low. The next day we had big volume, but we kind of finished right in the middle of the candle. So we took a big hit on this day, went flat the second day. And then since then, even during this period, you can see again, all these tails to the downside. And that means the AD line's going up. Somebody's buying in the afternoon. Okay, yeah, okay, we're going down for the day. But who's buying? I mean, there's gap downs and then there's a little bit of intraday selling in the morning. Who's buying in the afternoon? I can tell you who. Market makers are buying. They're buying for institutions. They're accumulating. Why would they accumulate? Well, obviously they feel like banks are going to do pretty well down the year. I agree with them. So just wanted to point that out. This AD line is really strengthening, and banks have been weak for so long. I mean, if we go back, look at the monthly 15-year. Actually, we can go back even further than that. Let's go back 25 years. That'll take us back basically to the beginning of the century here. 2000, you can see we had the big move down. We still are trying to get back up to the 2007 high. I mean, we went just a little bit above it in 2021, but we're still below where we were in 2007 at the peak. Think about that for a second. 17 years later, and this bank index is no higher than it was in 2007. I mean, don't you? I mean, we had this big move coming out of the pandemic to the upside, which set the all-time high in the bank index. Then we had another pretty big pullback during the recession or during the cyclical bear market. And that carried over into the middle part, even toward the fourth quarter of 2023, where we were still down. We actually were down lower than where we were at the end of the cyclical bear market in 2022. But look at what's going on here now. I mean, can you see the sudden reversal in trend? When that happens and you go above the 20-month and the 20-month crosses above the 50-month and that PPO goes positive, you should be thinking positive things in your head. I mean, here we made a big breakout, put in a higher low, and then made a breakout. And essentially, maybe back in the beginning of 2013, right about the time the secular bull market started, banks kind of looked then the way they look right now, in my opinion, just kind of getting started. And so over the next couple of years, I mean, I could see breaking out to all-time highs. And that alone, I mean, if this gets up to 700, 750 from where we are right now, that would be, let's say it gets to 750, that would be 225 points, which would be more than 40%. And if we were to do that over a couple of years, there's a good chance that the banks will be outperforming the S&P 500. And so that's really what I'm looking toward. I mean, we're just starting to get confirmation of something I was talking about last year. I thought banks were starting to look better middle part of last year. And then, of course, we took that one final plunge again into October. But now, kind of like the QQQ back in June, when I said it was bottoming, we had that one more drop in September, went a little bit below, and then we saw the QQQ take off. I think that's what we're getting right here in the banks right now. So I just wanted to mention that. Got a couple big reports coming out today. These are two of our stocks in our portfolios. We had one stock in our portfolio report Tuesday after the close. That was Crowdstrike. And Crowdstrike had a huge open. It did pull back, but you can see there was the earnings report. So we went from under 300 to yesterday's close at 329. So it was still a good day, but at the open yesterday was a huge day. I think maybe we see a little bit more weakness, maybe, but I expect that we're going to see Crowdstrike go back to new highs. It was a really good report, and you can see the volume. Now, there was, almost like exhaustive type buying at the end, when we opened yesterday, because we saw mostly selling after that and on a lot of volume. So maybe it takes a little while to consolidate, but I do think eventually we're going to get another breakout here on Crowdstrike. So Crowdstrike, if you look at it, I'm going to pull it up on a relative strength basis. Look at Crowdstrike relative to the software group just before earnings. I mean, this thing's been going up for a while. It's one of the strongest groups. Here's software relative to the S&P. It's been going up for many months. This has been one of the strongest stocks within the group. So when we talk about wanting to own leading stocks in leading industry groups, this is basically what you're looking at right here with Crowdstrike. So let me pull up the two that are going to be reporting today. The first is Broadcom, AVGO. They report after the bell today. AD line, very strong. Price action, very strong. Relative strength versus semis, it's been coming down over the last couple of months, so we'll see what happens here. I thought maybe we were going to hold right here at this support area because look at all that volume and accumulation that came in on this move to the upside. But I think today's going to be the day for AVGO either to, maybe it just starts going along for the ride and goes sideways. But if it wants to be a leader, it needs to have a good report and gap up today. And looking at semiconductor group, of course, you can see this has been going straight up. Now, if you look at Broadcom relative to the S&P 500, I'm going to pull that up here now. You can see Broadcom relative to the S&P has been going up. This is a leader, but this is what happens. Even bad stocks within a really good group can outperform. And I'm not saying Broadcom's a bad stock. It's just been underperforming its peers for the last few months, and it needs to change with tonight's earnings report. Don't know if that's maybe a little bit of caution ahead of the earnings report or not, but we want to see we want to see a good, solid report and a nice reaction on Broadcom. Otherwise, if it's weak, I would probably be watching somewhere between 1150 and 1200. And yes, these stocks can go down. This thing's gone up from 800 5 months ago to over 1400. Could it lose a couple hundred points? It could. This one is one that would be more if I was trading it. Now, in our portfolios, we hold these stocks. But if I was trading Broadcom, this relative strength line would probably tell me to not take any chances. Again, from a longer term perspective, this has been a leader for a long time. I mean, we could go back, maybe do weekly, and let's look at maybe the last 10 years. And I mean, you can see Broadcom over the years just has always kind of been this leader. But look at it. I mean, it's been straight up. If they don't have great numbers, we could see a hit to the downside. So I'm kind of on the fence on AVGO. One that I'm not on the fence at all about, though, is Costco. Costco also reports tonight. I mean, look at the price action. Look at the AD line. Look at the relative strength versus its personal product peers. I'm not even sure personal products is where Costco belongs. But no matter where you put it, it's going to be a leader. I mean, this is a stock that's been up 50% or more in the last 2 or 3 months. So clearly, Wall Street loves what Costco has to say and what they're doing. So I believe we are going to see a blowout report on Costco. But again, what does that mean in terms of market reaction? I don't know. Sometimes, yeah, it could be a great report, and it could be that the market has it priced in with this huge move. So sometimes stock comes out with great news, it gaps up, and then it sells off right after earnings. Kind of like a little bit like CrowdStrike. Had the huge report, gaps up, looks like it's ready to take off to the moon, and then you see selling all day long. You're just scratching your head. I'm not scratching my head. I'm actually watching for a buy point. I actually got in yesterday afternoon and ended up getting stopped out when it rolled back over again in the afternoon. It was a very small loss, but I'm watching CrowdStrike because it's one of the leaders in one of the leading industry groups, and I think it's going to be a great stock to own, or at least to trade. So let's watch AVGO and Costco after the bell today. These are stocks decent size. AVGO could have an impact on the semi group as a whole. Don't know if it'll impact NVIDIA. NVIDIA just goes up no matter what. But this one will be worth watching. Anyway, let's take a look at what's going on. Market just opened 2 or 3 minutes ago. We got the Dow up 210, S&P up 31, Nasdaq up 110, small caps up, everything up roughly maybe 0.5% up to about 0.75%. We got the VIX down a little bit today. We'll see if that holds. And then the other thing to watch, and I always look at this first thing in the day, is I pull up sector summary just to see what's leading early in the day. Materials, but then you've got industrials, technology, communication services, and consumer discretionary. That's good. What's it going to look like at 3 or 3:30 this afternoon, though? And what I do a lot of times, and I'm going to do it right now, is I just take a snapshot. 9:30 in the morning, I got the time stamp in there. So I can just take a snapshot of it, and then I'll come back to this later in the day and get a really good sense of what happened during the day. Where did the money go? Because it could turn out kind of like yesterday. Technology was maybe middle of the pack, or maybe even in the lower end of the pack, and it came back up and was number 3 by the end of the day. It tells me that there was pretty good buying yesterday, which was primarily in semiconductors once again. But I think looking at the sector summary in the morning and then looking at it throughout the day gives you a little bit more of a sense of how the market's trading. And that's important to a short-term trader. To the downside, you can see utilities, staples, real estate, financials down, or at least everything's up, by the way. All the sectors are up. But these are underperformers on a relative basis. So financial is actually underperforming today, which is maybe a little surprising. But still, utilities up. If we see during the day utilities and consumer staples starting to make their way up the board, and some of these aggressive groups start to drop, it's just telling me that the money that's coming in early to drive these other areas higher, that maybe we're starting to see more and more rotation. And I did a chart yesterday in the daily market report where I was showing how, I think it was in the daily market report, where I was showing that there's been some deterioration in the relative strength of some key sectors over the course of the last month, or even a little bit longer in the case of consumer discretionary. So we're seeing a little bit of deterioration. I mean, rotation and bringing other areas up to speed is also very bullish. You can't have all 11 sectors leading at once, but when you go through periods of consolidation or when we pull back, it's not at all unusual to see these aggressive groups maybe take a back seat to some of the more defensive groups, or even the neutral groups like materials and energy, which kind of interesting. One's leading and one's lagging today. Because if you look at the absolute charts, almost all the sectors are looking pretty good. And with utilities starting to make a move, energy's been making a move recently. I think consumer staples, let's look at that XLP. I know I was going to leave, but I want to just check. I mean, you can see XLP getting close to that high that we saw back in beginning of May of last year. So we're getting ready to set a new 52-week high in consumer staples. So yes, they've been underperforming. They haven't been going up as fast, but they're still making new highs. They're still making money. They're uptrending. And that's the key, is we want broad participation in terms of uptrending. We don't want all 11 sectors to outperform because they can't. It's impossible. During secular bull market advances, we want the XLP to lag. We want utilities to lag on a relative basis. But when we're looking at short-term, periods of consolidation, it's absolutely fine for some of these defensive groups to lead. But if we see it by looking at the sector summary, if we can kind of see that rotation during the day, it just gives us a feel that, yes, we're more in a consolidation period than we are in a true secular bull market advance. And that's the difference. And that's what I kind of look for. Anyway, that's it for me. I appreciate everybody tuning in. Thank you so much for joining us here on the live stream. If you can, hit that like button and subscribe to our channel. That will really help us in terms of the YouTube algorithms. So even if you're not a member and you're maybe not in a position to be a member, or for whatever reason, maybe you like to hear what I have to say, but you're not sure Earnings Beats is for you, although I'd still encourage you to take out 30-day trial and check it out. But if for whatever reason you're not a member, you can still help us. Hit that like button, hit the subscribe channel, tell your friends, and let's do this market thing together. Anyhow, I will see everybody back on Tuesday of next week for the next Trading Places Live. Have a great day, everybody, and enjoy your weekend. Happy trading.